Welcome to the deal preview for Solana at the Crossing, the latest multifamily investment opportunity provided by Cray Capital for accredited investors only. I'm incredibly thrilled to share with you this new apartment investment located in Indianapolis, Indiana, which is the home market of Cray Capital. We've been looking for an A-class, high quality asset with really high intrinsic value located in the suburbs. But the problem is, Indianapolis has been a popular market for the last several years. It's even more of a popular market now. And so getting in and actually winning any of these apartment projects has been incredibly difficult. And those who have been winning out have been frankly overpaying. And it's something that we just haven't been willing to do. We try to stick to our knitting, stick to our return criteria. And if it doesn't pencil, we just have to pass. Fortunately, though, we have found an asset, Solana at the Crossings, that has checked all of those return hurdles. It's exactly what we're looking for, and we are buying it at a deep discount, 25.5% discount compared to all other sales comps that are relevant to the market. On this presentation, I'm going to get into the details of our business plan, tell you about the property, look at returns, the risks. We're going to go over the Indianapolis market. So stick around. Feel free to fast forward and jump around. But one thing I would highly recommend, if you do not already have access to the Cray Capital investment portal, please visit graycapitalllc.com to sign up. Create an account so you can view not only this video, but our investment deck, due diligence materials, schedule a meeting with our investment team, and get all of your questions answered on a one-on-one basis. So let's get into Solana. Before we do, I want to jump in and take a look and give you just a tour of what Solana looks like. And I'm going to get in to talk about, again, the business plan, the market, the comps, what we're going to do, why we love this property, and why you should consider it making an allocation into Indianapolis multifamily. All right. So Solana at the Crossing, it's a beautiful A-class asset located on the north side of Indianapolis in Washington Township, the best schools in Indianapolis. If you don't count the furthest north suburbs, but really high quality schools. I live just about a 7-minute drive from this property. I know the area well. I know this property well. I drive by it a handful of times a week. And you can see it's in an incredible suburban location on the banks of the White River in Indianapolis, which is a major recreation spot. And it's an amenity that no other apartment community in Indianapolis has direct access to. There's a small handful of properties that are adjacent to the river, but none have their own marina, boat slip, boat ramp, kayaks that you can rent. I'm really leaning into the lifestyle community and millennials, Gen X's, and even older Gen Z renters who are looking for a high quality apartment but don't want to live in a strip mall. They don't want to live next to the interstate. They want to be immersed in nature, but still at an incredibly convenient location because we're right down the street from the best shopping in the state of Indiana, Keystone at the Crossing, all along 86th Street and 82nd Street. Whole Foods, multiple grocery stores, but also really high-end financial services jobs along the Keystone corridor as well as the Meridian Street corridor. I may get into more details about Indianapolis, but it's just one of the factors that has made us very convinced that this is one of the most compelling investment opportunities we've seen in Cray Capital in quite some time. If you've been following Cray Capital, we talk about Indianapolis as a market that has been flying under the radar for really the last decade or so. We haven't seen nearly as much institutional capital, but we have started seeing it as of recent, as Indianapolis is one of the top rent growth markets in the entire country. In terms of the economy in Indianapolis, back in COVID, we experienced the second least amount of job losses compared to any other major city in the entire country. It's a true story of kind of slow and steady wins the race. We don't see the busts. We don't see the huge booms that they see in markets like the Sun Belt, but we see really strong growth. And that growth, the net result, outweighs the boom times that the Sun Belt is seeing. So the net result over the last several years, where markets were growing 20 to 30%, well, some of those markets declined afterwards by 20%, but Indianapolis has compounded that growth. We didn't decline during COVID. We've stayed positive during the retraction that we saw at the end of 2022, halfway through 2023. Now the apartment market is kicking back up. But the one difference is that sellers are much more distressed and cautious, and prices have readjusted. And this is giving us a prime opportunity to acquire high quality real estate that's cash flowing at depressed prices and even slightly depressed rents. Because again, last year, the rental market, even in Indianapolis where rents were growing, the rental market was significantly softer than it has been in recent years. But now as supply is beginning to slow down, with deliveries set to really almost grind to a halt near the end of 2025, the demand is not slowing down. We're seeing absorption rates near a 20-year high across the country. So this is setting us up for a really exciting scenario where we're going to be buying low and then taking advantage of the growth. And fortunately, Solana, as we're going to look into the financials here in a minute, is already starting to see some of that growth, really getting a head start on our business plan. Because, I'm going to take a step back. We could acquire Solana just at the great price and the great basis. As you can see, the units are really nice. They're competitive and comparable to brand new 2024 built construction. But we're buying at a fraction of the price. We could not do anything. We could just let things appreciate, and we could let rents continue to grow organically. We don't just want to rely on the market, however, and so we have developed a really, I believe, smart, tactical, light value add strategy aimed at modernizing and making sure that Solana is a competitive property, not just the first few years after we buy it, but over the entire hold period, which we're projecting for 7 years, and to stay modern for the next buyer. When they purchase it in 7 years, they can look at it and say, these units are modern, they're great. They can pay a price that's relatively moderate relative to the rest of the market, and we can still hit a great return, and we can exit at a very strong multiple. All right, well, let's just get into some of the details. I might go back to this video later on. You can find this video in our investment deck, and we're gonna have all kinds of other materials from our due diligence walks, some more drone footage, all kinds of stuff. And again, if you're ever looking for anything in particular, never hesitate to reach out to us. We're a transparent group. We'll share it with you if we've got it, and if we don't have it, we will find out where we can get it and send it over to you. Let's start taking a look at some of the details for the project. Solana was built first in 2009 as a for-sale condo project. They only built the first 3 buildings in the clubhouse. However, the great financial crisis threw a wrench in the gear of the plans to sell those condos. Eventually, they were sold to an apartment developer where they dissolved the homeowners association, built the remaining units, about over 300 apartment flats, and solidified the entire property as Solana at the Crossing as 100% market rate apartments located on the north side of Indianapolis, again, just south of Keystone at the Crossing, right on Keystone Avenue, which is a major thoroughfare in Indianapolis, the capital city of Indiana. We're looking at a 7-year projected hold period. When I say 7 years projected, we're really looking at a really kind of a 5 to 10 year overall hold, with 7 really being the target. If there's a great opportunity to sell in year 5, we'll take advantage of that. But then if we have a major recession in year 6, we want to make sure that we can hold out for another couple of years. So 7 is the target. We might sell a little bit sooner, a little bit later, but certainly we're not in for a short-term flip by any means, and we will absolutely be looking to return your capital as soon as possible, but potentially with a refinance in the first several years, regardless of whether interest rates come down or even come up a little bit, because we believe that we're going to be able to force a ton of appreciation at this asset, and some of that's going to happen before we even close on the property itself. In terms of projections and some of the general economics of the deal, we're offering an 8% preferred return to our limited partner investors, followed by with a 70-30 split, LP and GP split. After preferred return has been paid, 100% of capital has been returned back to investors. That's when that 70-30 split comes into place. What that means is essentially we're looking at a 9.5% average cash on cash over the 7-year hold period, a 16.5% projected IRR. I'll show you a sensitivity table here in a little bit, and a 2.34 equity multiple, again, all over 7 years. We're purchasing Solana for $68,250,000, and that comes out to $178,000 per unit. Which, if you're familiar with construction costs, and if you've been tracking, what apartments have been selling for, this is a deep discount to new construction and a deep discount to where similar vintage properties have sold recently as just last year. But first, I want to learn a little bit more about Indianapolis. If you're not familiar with Indy, it's a great dynamic city, strong population growth, strong job growth. There's a lot of really great stories. We're a diversified economy with bio and pharma companies such as Eli Lilly, Roche Diagnostics, driving other startups and smaller firms in the bio-life sciences field. Logistics is a major contributor to the Indianapolis economy. We're strategically located where we can access on a day's drive, if we're shipping cargo, 80% of the U.S. population, again, in just a single day's drive. So that's why FedEx, for example, has chosen Indianapolis as their second largest hub in the world for air cargo. Indianapolis International Airport is the busiest airport in the country for cargo air travel, for air cargo. Really busy airport. It's one of the nicest airports in the country. It consistently gets ranked by Condé Nast as the nicest airport in the United States. Love to invite you to Indy anytime. Come and check us out. Check out the Great Capital offices. Take you for a tour on Solana, and you can experience the Indy airport. Indiana is a very pro-business, tax-friendly state. Property taxes are low. They're consistent. We're not aggressive on reassessments, but we know this. We know Marion County, where Indianapolis is. We know Indiana, and we know Indianapolis. So a lot of confidence just from the Great Capital side of being familiar with the tax and paradigm, but just in general, Indiana is a very tax and business friendly state and landlord friendly state. I mentioned our diverse and stable economy, logistics hub. I didn't mention that CSX has a major headquarters in Indianapolis as well. Got all, of course, meds and eds, several universities, Indiana University, Indianapolis, Purdue University, Indianapolis, Marion University, University of Indianapolis, Butler University. I'm leaving off a couple, but we have a strong handful of universities and colleges in Indianapolis. Also, just a very affordable place to live. This is good for residents. It's great for when you're raising a family, but we're also attracting net in-migration to Indianapolis from cities like Chicago and elsewhere that are seeing high taxes, high living costs. They cross state lines, come down to Indy. It's a great living experience. Things are relatively affordable, but employers also really like that because there's a large educated workforce that is cheaper than many of neighboring cities and states. So we're getting a ton of economic development coming into Indianapolis because we've got the workers, we've got the land, we've got the natural resources. Like water isn't a problem for us here in Indiana. We've got a ton of groundwater. It's everywhere. We don't have natural disasters. There's no earthquakes, there's no hurricanes, things like that. So again, just a very stable market. I didn't mention manufacturing. The Midwest is seeing an absolute manufacturing boom right now. It seems like I can't go a week with another battery plant or a semiconductor plant or an EV factory that is coming up. And, for example, up in Boone County, the Leap District, Eli Lilly is building a $3.8 billion facility. There's a semiconductor foundry that's going to be going there as well, amongst a host of other kind of high-paying manufacturers that are going in on the north side of Indianapolis, not too far away, just down 65, then 465 to Solana Apartments. Getting a little bit more granular with where Solana is in the market. You can see on these maps, we've really identified the different neighborhoods, try to give you a sense of kind of what part of town is Indianapolis. I feel like a lot of times you're looking at an investment opportunity for a piece of real estate, you may be semi-familiar with the city. we could not know a market any better than Indianapolis. Not only have I was born and raised in Indy, I've spent most of my adult life living here, but specifically on the north side, again, about 7 minutes away from the Solana apartments themselves. I have family members that have lived at Solana. I probably know a dozen people who have lived at these apartment buildings and have only had great things to say. So again, it's got a great reputation. Let's look at where it is in some of these neighborhoods. Again, Keystone at the Crossing. This is the highest end Simon Mall in the state of Indiana. Simon is headquartered in Indianapolis, so they'd like to keep it up, being their nicest mall in their hometown. Keystone is also surrounded not just by shopping, but by businesses as well. CBRE, JLL, Roth Mortgage, UBS Financial, Somerset CPAs, Charles Schwab, USIC. All of this is around this Keystone corridor. As you continue going down 82nd Street, you have tons of retail, the highest end shopping. It's all right there. If you start going west, you get into the Meridian Street corridor that also has a ton of high-paying jobs from tons of medical companies, Franciscan Health, IU Health, but Anthem, Geico, Liberty Mutual, Delta, Faucet, Republic Airways. I could keep going on and on. But the neighborhoods in particular, just to the west of Solana would be the Williams Creek neighborhood, really along that Meridian Street corridor. Really affluent neighborhood with an average household income of around $145,000. But really, if you get even smaller, there's probably up into the high six figures. Meridian Hills, similar, older neighborhood. A lot of the homes were built in the kind of the 60s, 70s, but strong incomes, cranking around $164,000 on average income. Nora has some higher incomes. There's a decent amount of multifamily in Nora as well, and there's some affordable housing that brings that number down a little bit to $91,000 of average income. Still pretty strong. And then if you go further north into the Hamilton County suburbs, which the dividing line between Indianapolis, which is in Marion County, and the northern suburbs, which is Hamilton County, is 96th Street. So Carmel, for example, we've got a median income of around $132,000, and Fishers, a median income of $117,000. So again, we're surrounded by high income earners, high income producing jobs, shopping. Again, this is where you want to be. And it's highly convenient. You can immediately get to Carmel, the northern suburbs, from Keystone, just going north, because Keystone turns into a freeway once you get into Carmel. And we're going south, you can get to Broad Ripple, which is where kind of the cultural hub of Indianapolis is, much more artsy, and you get the music, bars, restaurants, some offices, but mostly kind of cultural activities going down in Broad Ripple. Glendale Mall is down there as well, but very convenient. But then getting downtown is also a breeze. You can just shoot directly down Keystone, pop on over, or you can go over to Meridian Street. It's about a 20-minute drive. You can get about anywhere in Indianapolis in about 25 minutes. It's a convenient city. It's not too big. It often feels like a small town, even though the MSA's got a population of over 2 million people. And man, the north side of Indy really can seem like a small town at times, at least when we've been here long enough. So we're very excited about Indianapolis. We're very bullish on it. There's so many things going on. Just knowing the city firsthand. One of the reasons I moved back to Indianapolis and I got into real estate because I was inspired by the growth of Indianapolis. I wanted to be involved in the revitalization of some of these neighborhoods that were just, crime-ridden drug dens years ago when I was growing up. All of a sudden, they're being fixed up and improved. I wanted to be a part of that. That's when I started flipping houses near downtown Indianapolis. And so I'm so excited. We've got another opportunity to invest into my hometown, Indianapolis. But it's not all just about, great, we've got a deal in Indy and I like Indy. We're getting an incredible deal. So this is proprietary information. This is directly from Indianapolis, the top Indianapolis brokers. We're not listing all the property names because it is a little proprietary. We've listed the submarket. Most of these are in Washington Township where Solana is, but not all. So again, we took of all the recent sales comps, the average year built was 2013. And again, Solana was built in 2014. So we're comparing apples to apples. The sale dates on all of these We're just in the past 2 to 3 years, so all recent sales comps. But this is going to be capturing some of the top of the market as well as some of the recent prices. So let's see where we are settling. Again, and a reminder, we're acquiring Solana for $178,000 per unit. However, the average per door sales price of all of the comps, the relevant comps, we're not cherry picking these. The average sales price was $252,000. That's a massive discount. In fact, it's 25.5, more than a quarter off compared to discount relative to the market. Now, I don't think that we're going to get back to average sales price of $252,000 next year, the year after, but I do think that's where we're going to be going back to, certainly over the whole period of this investment. And I wouldn't be shocked if we were getting closer to the $300,000 per unit, closer to the end of this project. We had several $300,000 per unit sales. One $400,000 per unit sale actually was a property that we sold back just a couple of years ago. So our basis is strong. We're getting a great deal. The seller is not absolutely distressed, but they're a little pressured right now. They're at the end of their hold cycle. It's an institutional group that has a 5-year clock. They've got to sell it at the end of the 5 years. They are basically going to be breaking even on this transaction. They acquired it just prior to the pandemic in 2019 for $63 million. So, with their costs, and they put a decent amount of money into the clubhouse as well. We're really getting at a similar total cost basis as they put into it back in 2019. And you've probably said to yourself, if only we could go back to 2019 and buy as much real estate as we can to take advantage of the run up in prices. Well, we are getting that opportunity to go back into a time machine and essentially, buy assets at pre-pandemic pricing, which is really, really exciting. All right, let's get into a little bit about, again, why we love this deal. No, let's talk about our co-invest and skin in the game. We're always large co-investors into each project. I'm looking at finalizing what I'm personally putting in the deal, but we'll be putting in at least $1 million of cash, not including fees. We'll probably roll more of our fees into the project, but we are investing over $1 million of cash into the project itself. I've talked about our great basis. I've talked about we've got a local advantage, the great submarket. We'll get more into the returns. I want to talk a little bit about the value add plan and what we're going to do. Because like I mentioned earlier, the property's in good shape, and one could say, why do anything? Why put any more money into it? It's in it looks great right now. The problem is it looks great right now, but in 5 years, it's a 10-year-old property, 2014. In 5 years from now, it's going to be 15 years old, and there are going to be some things are going to happen. It's going to weather. The paint's going to be faded, and we want to stay competitive with the brand new construction because the rents at Solana are lower, the units are bigger, the setting is nicer. We've got everything and more than the competition has, so we need to stay relevant and competitive. So just looking at some pictures, these are current unit finishes. Again, really nice kitchens, nice countertops, nice cabinets, nice floors, in-unit washer and dryer, fans in bedrooms. Again, really, really good. But we want to take it to the next level. We're going to do a couple of things. First, on the interiors. Now, this is really a tactical unit modernization package that we're going to be deploying. We're not going to be, changing everything. Now, the advantage of this is this can be done by our maintenance teams on turns. It doesn't require hiring an outside contractor. These can be done really quickly. What we're going to do is we're going to replace the kitchen faucet with a statement piece kitchen faucet. Again, the kitchens look good right now. There's a little bit of a dinky faucet. When we want a resident and a prospective resident to come in and tour these apartments, we want them to be wowed. And what do people look at? They look at kitchens. The kitchen already looks nice, but if we can draw their attention and their eyes to a very modern plumbing fixture, they're going to have the sense that this is a apartment that is on par with the brand new 2024 delivered units. We're also going to be adding some new lighting, again, for that same reason, just in the kitchen to draw the attention to that area to say, all right, this is a newer unit. I'm getting the same thing, but at a huge discount compared to the competition. We're also going to be adding smart thermostats, which is great from a property management perspective, as well as just from a nice amenity. We're also going to be adding smart locks. Also, really helps us from the management side. We don't have to deal with keys. But again, a resident is going to have the feeling like they are in a brand new apartment unit relative to, pulling out their key and entering their door every time, which is fine. But that's how, that's how we did it in 2014 and in 2009 and in 2000. It's not how we're doing it in 2024. And so if we can just take these small elements that remind us of how properties were built 10 years ago and insert the elements that remind us of apartments that were built today, we can dramatically narrow that gap of spread between Solana and the competition. Additionally, in turns, we're going to swap out some of the appliances. In addition to these interior features or the interior upgrades, we're also going to be swapping out, we're going to be repainting the exterior of the property. As you saw, let me pull up another picture here real quick of Solana. The painting is totally fine. It's kind of a multicolored pastel scheme. I think this would look great in the Carolinas. We want something that pops. Again, it's fading a little bit. We really want to have an asset that pops and is a little bit more bold and stands out. So we're going to give the whole entire property a new paint job, new color scheme on the hardy plank siding. It's not vinyl, it's hardy plank. There's a lot of brick and limestone. We're not going to paint that. We're just going to be focusing on the hardy siding itself. Once it's said and done, again, it's going to look like a brand new apartment community and is going to be incredibly competitive. But I want to show you why it's going to be so competitive. And we already are very competitive. So this is a chart, a scatter plot, looking at our average square footage as well as our average rent for Solana compared to all the comps. Now, again, these are not cherry-picked comps. I know these comps intimately. I have tried to buy probably half of these comps. And then if I haven't bought them, I know who owns most of them, or I'm very familiar with them. So you can see Solana has some of the largest floor plans in the market. Huge, average square foot of 1,050. But our rents are some of the lowest in the market. The average per square foot at Solana, when this chart was created, we've gotten a couple updated rent rolls I'll show you here in a minute, showing the progress that Solana has made just in the last few months. We're at $140 a foot. That's what a lot of B-class properties. In fact, I'll show you in a minute. There are some, for example, Lakeshore apartments you can see on this chart. It's a 1986 built asset, and it went through a value add, but it was still built in 1986. And I'm looking at, this line right here. Solana should be much closer really to the Seasons of Carmel, which I think is one of our primary comps. It's in Washington Township, right down the street. It's in the basically kind of Nora submarket, not too far away at all. They have a few more garages than we do. They are technically in Carmel, which there is an advantage there. People do really like Carmel. Being the north side of Indy is nothing to scoff at as well. Another really good comp is Lake Clearwater in Indianapolis. It's along 82nd Street, just a little bit east of Keystone at the crossing. It is next to a lake. It's not next to the river. You don't have access to the lake. It's just kind of back there. You're behind a strip mall, which does have a convenience factor. But you're living behind a strip mall essentially versus living in a majestic setting along the river, which literally you have bald eagles and herons flying over you every single morning, and you can rent a kayak. So we're at the bottom of the market. Now, that's just rent per square foot. Residents do buy, what their actual payment is. They're not necessarily looking at a per square foot price, but having larger floor plans does make us incredibly competitive. All right, so this is taking a look at our rents from a previous rent roll when we first made this chart, looking at the most recent rent roll that we just received from April, as well as looking at where Solana's rents will be after kind of we execute our value add plan and we start moving rents after the first year. So you can see we are moving rents, but it's really in line where it should be, and we're already making some progress. As you can see, we were down here where Lakeshore was not too long ago, under $1,400 on average per month. The current owner has started increasing rents as they've noticed that they are under market, and they are now closer to $14.50 per month. It's some solid progress. What we're looking to do is really get a $200 to $250 premium, which is combined with our value add plans, the tactical modernization package, as well as just narrowing the gap and just reducing the organic kind of the loss to lease, and basically eat away at our loss to lease. So after year one, we're going to be right in line with Lake Clearwater, which again, 2014 construction, so very similar vintage, it's Washington Township, same school district, just a couple miles down the road. I would argue that Solana, again, I wouldn't argue, the floor plans are much larger. They're going to be really nice. We'll have gone through this modernization package. And again, we have this amenity that they do not have, which is being on the water. Okay, looking at just one bedrooms, that was just our average rents. Looking at one bedrooms, you can see, again, we're really far below the market at $1,200. We have a lot of room to go. As you're looking at this, it's pretty obvious. We're about $400 to even $600 below the comps when looking at one bedrooms. Looking at two bedrooms, it's the same thing. We're right around $1,600 for two bedrooms, down at the bottom with kind of older assets. But then over on the other side, we see assets that are over $2,200 per month. The Coil, which is in Broad Ripple, which it does have a grocery store on the bottom, so that's its one competitive advantage. It's all the way up at $2,600. So I'm not saying that we're going to get to this $1,000 difference right now, although there is $1,000 difference between these two apartments. We're really targeting, again, Lake Clearwater up to Quarry, the Edge Apartments, new apartment community in Indianapolis, really close to that Seasons of Carmel property that I mentioned earlier. 2024 construction, but again, smaller floor plans and not nearly the amenity set that Solana has, and it's basically behind an interstate without an exit. Not a bad location by any means, but we're not really comparing apples and apples. All right, let's talk about kind of the structure of the deal. We mentioned the 8% preferred return, the 70-30 split. We even talked about the returns. The minimum investment for the project is $100,000. And fees being charged on the deal to Gray Capital. We just have a couple one-time fees. We charge a 1.75% acquisition fee on purchase price. There's a 0.75% loan guarantee fee. And then recurring fees, we have 0.5% asset management fee, 3% property management fee, and a 5% construction management fee on construction projects, of which we manage. We do our own property management. Gray Residential is our property management firm. They're some of the best in the business. But being here in Indianapolis, again, it's even easier for us to manage. We manage across the state of Indiana. This being our backyard is an incredible opportunity. Okay, so let's get the brass tacks. What does it mean when you make an investment? You hand over, whether it's $100,000 or $5 million, what are your yearly and monthly expectations? As a reminder, we are always doing monthly distributions. That's what we do here at Gray Capital, as well as monthly reports. So we have an annual projection as well as a monthly projection. So in the first year, if you are a $100,000 investor, you will be receiving a total of $6,400 in that first year, or a 6.4% cash on cash return. That will increase to 8%, or $8,000 on your $100,000 investment by year two. By year four, we are anticipating a refinance, and where we will return around 45% of your capital along with your preferred return. That will generate a 55% cash on cash return, or a $55,000 on your $100,000 investment. Now, again, that has an asterisk in year four because we don't know where interest rates are going to go. In our projections, and the deal doesn't need to be refinanced, but it is part of our business plan. Even if interest rates stay where they are, and even if they increase, we'll still be able to refinance. And you can find a refinance sensitivity table in our investment deck, and it's something that I can let's just take a look at that as we speak. So again, our assumption is the interest rates will be around 5.5%. There's a little speculation, rates will come down just like a tad bit, which I think is essentially consensus for the market right now. But even if interest rates increase, again, you go out to get fresh debt today, we're assuming a 5% loan on this project. But if you did get new debt, it would be around 6%. Even if rates increase at 6.5%, we're looking at really strong proceeds. So of where anywhere between 61 million and 55 million. 55 million would be if we had kind of a base case NOI and interest rates were at 6.5%. Now, if interest rates drop, which the market is saying they will, the market's wrong most of the time, but if they drop to 4.5, we would then be cashing out closer to $69 million. So great opportunity to return capital. We don't think we're going to return 100% of capital, although anything is certainly possible. Now, looking at some more sensitivity analysis, since we're on the subject, we don't know where cap rates are going to be, and we've penciled in a 5.5% cap rate in year 7. We think that is a modest assumption. It could be higher, it could be lower. So again, on the worst case or less ideal scenario, this isn't worst case. Worst case is always, we've messed up the deal in some way, or there's just something that happens at the property or the economy that we just can't control. I mean, total loss is always a risk in any investment, and nothing is ever guaranteed. But typically, if things just go the wrong way, we do an okay job on operating, and we're going to do a great job, by the way. But if we just do an okay job and we sell, in year 5 at a 6.5 cap, which I don't think Solana's ever traded at a 6.5, but things can happen, and properties used to trade at a 6.5 cap about 8-9 years ago. We would be in the kind of the 13% internal rate of return range, or a 1.6 multiple. Again, that's on a 5-year exit at a 6.5 cap. Our base case is selling at a 5.5 cap at 7 years for basically a 16.5 IRR or 2.34 equity multiple. Again, if interest rates drop, cap rates drop, we could be easily in the mid-20s and over a 3x IRR. But we'll leave that to the speculators on CNBC, what the future is going to hold. We're just assuming that things stay relatively similar than they are today. That's our base case, but there is material upside if things do improve. And again, we're giving ourselves 7 years. The real estate market over time goes up. Like, there are periods of decline, which is what we just experienced right now, which is why we're getting a good price. So now we're going to use time as to our advantage and let the market recover while we force appreciation through our business plan. This is not the first time, we've done a project, great capital. We have 16 active projects. We've gone full cycle on 9. Our average IRR is 34%. Now, we never project IRRs at 30. We've never projected an IRR in the 20% range, let alone 30% range, but those are the results that we've delivered. Now, the market was very favorable during this period of time. So, certainly we did some great deals, bought some great assets, managed them well. The market really helped drive those returns. I think they would have been in the high teens, mid-20s if the market hadn't compressed like the way it did. But we've got a lot of active projects that are cash flowing. But what may differentiate Great Capital from some other firms is, again, capital preservation is our number one priority. We've never lost a dollar, an investor's dollar. We've never issued unplanned capital calls ever, and we have no anticipation or no plan to do so in the immediate future. I mean, you never say never, but we've never had to do it, and we don't plan on it. We don't have a loan maturity until 2027. There are a lot of distressed operators out there right now. We are just the opposite of distressed. We took a period of when prices were so high and we weren't doing deals. We really leaned into our operations, tightened all of our systems up so we could provide the best investing experience that we possibly could. We also are major co-investors into these projects. It's the only way to align interest is with real skin in the game. Our average co-investment into the deal is 14%. That means 14% of the equity is GP equity. It's my money. It's my family's money. We are often, not always, but often the largest single investor in any given project. So again, we're thinking about these deals the exact same way that you're thinking about it. And we're looking at what the LP returns are, not looking at our fees, not looking at, our promote. Obviously, we work really hard for those things, but we're putting our money to work right along you. And that's the only way to truly align interest. Before I go, I wanted to do two more things. One is I want to touch on a couple of case studies of just great capital projects that I wanted to highlight. And then I just want to do just a quick, brief overview of the great capital team to see the entire team that you're going to be working with as an investor into Solana. The first project is Villas on for Apartments, a 2018 built asset that we purchased in the depth of the pandemic in 2020. This is an example of a property that it's newer. It's something that this looks like a high class, A-class trophy asset. You're going to have to pay up and not get a low return. But it's at a great price, and basically by just improving operational efficiencies, really reducing expenses such as marketing, admin, and then moving rents to market, we have been distributing double-digit returns ever since the first year of operations. We distributed over 15% cash on cash back in 2023, and we anticipate keeping those high mid-teen returns up to great capital investors. The second project is a full cycle deal we no longer own called Pinnacle on Meridian in Indianapolis. This is only a 36 unit project, but it's in the same submarket as Solana. It's one of the sales comps. We sold this as it was the highest price per unit apartment sale in Indiana history. This was a condo deconversion, very large units, 2,200 square feet. We had to buy out some of the existing condo owners, dissolve the homeowners association, kind of package it up, build out a couple of units, and eventually sold it. A little bit of a complicated, more complicated project than our typical. We kind of label it as more opportunistic. I think the risk level was really high, a little higher than our normal, but it's an example of the Great Capital's team ability to take on complex projects and situations, turn them around, and execute for a really strong return. That deal ended up delivering over a 2x equity multiple and a 38% IRR. Now, again, to highlight the Great Capital team, I have the privilege of working with some incredible professionals, not the least of which is my co-founder and the president of Gray Construction Design, Alex Gray. Andrew Bosway is our chief operating officer, kind of keeps all of the trains running on time and assists with our systems and processes and technology and also HR. Jay Reeder is our chief investment officer that leads acquisitions and asset management. Christina Green, industry veteran that leads our property management teams at Gray Residential as our director of property management, and Joe Powell, our director of maintenance. This guy, incredibly brilliant individual that really gives us an edge on building systems, maintenance, preventative maintenance, CapEx. We've got a really incredible team. And then again, a large handful of other individuals that make up the rest of the Great Capital corporate team. And now we're fortunate to have over 50 employees at the entire Gray organizations between Great Capital and Gray Construction Design and Gray Residential. All right. Well, thank you for watching this deal preview for Solana at the Crossing. If you're watching this video, that means the deal has launched. So go over to the Great Capital investment portal at graycapitalllc.com. If you don't have an account, sign up for access. You can get all the due diligence materials, schedule a meeting with our investment team to answer any of your questions, and make sure you subscribe for this deal in the very near future because we have oversubscribed on every single one of our projects. And this one is exceptional between the great location, the market, the high quality, and the returns. This one's going to go quick. So make sure you sign up before it's too late. All right. Thanks again. I'm looking forward to talking to you soon. And I appreciate your partnership on Solana. All right. Let's get to it.